This
We are
conference
live.
will now be recorded.
See, now we're live, and we heard the voice. Cool. So hey, this is Ed with Capstone Realty Professionals. Thanks for joining me today. This is another Capstone Raw, and today I am super excited to introduce my friend Warren Taryle with Taryle Accounting in North Scottsdale, Arizona. When Warren and I sit down and talk about real estate, like he's one of those accountants that just seems to know real estate better than most, and I just thought it fitting. Yeah, sorry, man. That's how I think of you, really. So I think, like, knowing that he knows that amount, he was so, I mean, gracious, man, with your time. Thank you for coming on to answer some questions today that we get regularly. And yeah, I look forward to asking some of these questions. Hey,
All
Ward,
right.
so how'd you get into accounting, and what do you think of real estate here in the Valley?
Well, real estate, I'll tell you what I think first. I'll give you a little bit of background. To
Yeah,
me,
yeah.
real estate is the magic that we get to use to really drastically reduce a lot of people's taxes.
Okay.
It's a huge tool in that. So where I came from in real estate, so as you said, I'm a CPA here in Arizona. Uh, I have a master's degree in taxation. I don't say that to brag, just so you know why I don't have a personality. But
Nice.
uh, so when I was studying in college taxes, I focused really heavily on real estate because my family's business was in real estate back in St. Louis, Missouri. My
Awesome.
grandfather developed shopping centers and rented shopping centers and all that. So I figured, just for my own personal benefit, I had better pay attention to some of this stuff. And when I graduated and started working, I was really surprised to see how little a lot of my fellow accountants knew about real estate when, in my opinion, it's the biggest tool we have to
Yeah.
reduce taxes.
Right on. So, I mean, like from a family perspective, were you like jumping into your family finances like early on, and everybody's like, Warren, hey, like, hold on, right? Was it like that?
No, they kind of actually honestly pushed me that direction, right?
That's
Uh, they're like, yeah, we're spending all this money on accounting fees. You should know some of this stuff.
awesome. Okay, then that leads to the next question. Did you really want to get into accounting, or was this something where your parents or your family was like, hey, Warren, we got a space over here that we really could use some help?
No, actually, I started in electrical engineering,
Oh,
and I
seriously?
worked for a fire alarm company. I was a install liaison. We'd install these really elaborate fire alarm systems in a lot of military bases and stuff, and I had to get all kinds of security clearances. My don't have time for this story, but at one point my mom thought I was secretly working for the CIA because of all these clearances I had to get, and I did interview with the CIA once on campus, so she just thought I wasn't allowed to tell her.
That's
But
awesome. How fun.
my family actually recruited me to leave California and move to St. Louis, Missouri, as
Okay.
a young 20-year-old to work in the family business. And I was really working not on the financial side, more on the sales and other side of it. And they just thought I had this knack for numbers and understanding this stuff, and they really put pressure for me to go back to school and learn accounting, and I'm very thankful that they did.
That's awesome. Yeah, to pull a 20-year-old out of California to St. Louis, I mean, that's got to be a big pull. That's a good draw right there.
Right? I was kind of figuring I could be this little fish in this big pond, or
Yeah.
maybe be a bigger fish in a medium-sized pond. And
I like it. There you go. Awesome. Okay, so let's get started with some of these questions. I'm going to grill you with some of these because these are good ones.
that's
Yeah, and I think a lot we have consistency in some of the questions that I get on a regular basis. And let's start with the first one, which involves capital gains, right? And we get the capital gains question a lot. So what do typical capital gains taxes look like for owner occupants living in a home for less than 2 years? And why is that? Why is 2 years important, and all of that?
Okay, perfect. So yeah, when you sell even if it's your personal residence, when you sell your property, it's subject to capital gains tax on any profit that you earn. Currently, the top bracket for capital gains is 24%.
24. Okay.
Most people are kind of in the 10% range, but if your income's up there, you'll hit 24%. Uh, And that's again just on the gain. So it's on the difference between what you paid for the property originally,
Okay.
all the money you might have put in for improvements. So you need to really keep track of that stuff. And then so you subtract all of that from the sale price plus your real estate commissions and all the other expenses. Whatever's left over, that's what you're going to pay the 24% on.
Okay. So the 24% or whatever that percentage would be, how do you know what you're going to be paying based on when you sell it?
So, I mean, the exact rate, whether it's going to be, it ranges actually from 0% to 24%. So where you fall in that range is going to have to do with what all your other income looks like.
Okay.
And so it's really hard to say. That's why I always just tell people figure 24% and be pleasantly surprised otherwise. Now,
Okay.
you brought up the 2 years, and that's the significant number. Is we've had in the tax code for quite a while now. I'm actually old enough to remember before this existed, but in the tax code now, you can sell your primary residence. So it has to be the place that you live as your primary residence. You can only have one primary residence at a time.
Okay.
If so long as it's been your primary residence for at least 2 out of the past 5 years, and that you also owned it for 2 out of the past 5 years, and you think, oh, why do you say those two things together?
Okay.
Well, let me tell you what you get first of all. So if that is all true, you can exclude up to $250,000 of capital gain, right? Up to $250,000 of that gain recalculated, or
Okay.
$500,000 if you're married. So that's pretty big, right? So we can exclude all that from having to pay taxable gains if it was both your primary residence that you lived in it and you owned it for at least 2 years.
Okay.
Now,
Owned it for at least 2 years.
owned
So
and
the 2 out of the 5.
owned and occupied it, and that time doesn't have to be. And the reason why we bring them up separately is strangely enough that time doesn't have to be the same time, right? You could have rented the house for a year,
Okay.
been the renter, then bought it from the person renting it to you and lived in it for another year, and then decided to rent it out for the final year. So you owned it for 2 years and you also occupied it for 2 years. Like I said, those times don't have to sync up. We just have a 5-year look back, and that has to count.
It's just in the last 5 years. What does that look like?
Right.
Okay. So then, all right. So back to the initial part of this, less than 2 years. So what happens if you're a year into after buying the house? What do you do? Like, what are you paying gains on? What does that look like?
Well, there's a few exceptions to that 2-year rule that will still allow us to exclude some or all of the gain that you made on that property. So
Okay.
first of all, if it's one of the exceptions is it's a work-related move. So if you take a new job or you're transferred to a job, and the rule says that the new job has to be at least 50 miles from your house further than your old job was. So if your old job was 10 miles from your house, then your new job has to be at least 60 miles from your current house. So that would facilitate a move. They would say that 50 miles is enough to make you move over.
And this is anywhere in the country, right? So better. Okay.
Yeah, I mean, you can move. Is Phoenix big enough that you can move across town 50 miles? Maybe.
Yeah.
And you're also allowed, let's say, and I'm not sure exactly how this works, but I say if you had no commute, no commute from your, and then you got a job that's 50 miles away, that still counts. So like if you're working from home presently, and then you start a new job that's more than 50 miles from your house, then that also would qualify you for this.
Okay. Okay. So question for you.
Yeah.
I've got some clients right now that are working from home.
Right.
And they bought their house a year ago. And in that year where they live, they're going to make 30% on the sale because the market has exploded in their particular neighborhood. So now when they move after just 1 year, technically they are going to move more than 50 miles away, but 50 miles away from what? Right.
So if they're working from home again when they end up moving, that's not gonna fly. They'd have to get a job that they have to go to outside of the home that's going to be 50 miles from where they used to live. Now, I don't know of any kind of time requirement that they have to hold that job, but
Okay.
they have to basically move for that job. So,
So if they got a job where they're moving,
yeah. And it just needs to be one of the, if they're married, we only need one of the two of them to get that job.
oh, okay, that makes sense.
And then
Very cool.
let's just so that's one of the exceptions, but let's finish that conversation off. So what
Okay.
happens, let's say it's instead of 24 months, it's now 12 months.
Okay.
Basically, we prorate the exclusion, which basically means, I said it's 250,000 for single and 500,000 for married. If
Yes.
you're only there for half the time, then we cut that number in half, and it's 125,000 for exclusion for single and 250 for married.
Okay.
So the longer you're there, the more of an exclusion you get, but also the longer you're there, the more of the profit there might be.
Totally.
A couple other.
So the
Okay.
question then, so what you had referenced when it comes to like the 50-mile exemption, is that exemption, or are all the exemptions similar in how much it's going to offset the amount of gain?
Yes. Yes.
Okay.
Anytime however much you shorten it from 2 years, the percentage that we shorten it from 2 years is the same percentage we reduce the exclusion. Now, if they only had $100,000 gain, even with the 12 months, they still exclude the whole thing, right? Because we get 125 or 250 if they're married. So we still exclude the whole thing. It's just, if they have a really big gain, we might not get all of it.
Okay, so in this particular case, if they're only going to make $120,000 in the sale after 1 year, then not a big deal because they're excluded anyway.
Right.
Okay.
So we just got to get them a job somewhere 50 miles away. I don't know, maybe like Burger King or something. I don't know.
No, but if they're under the 250 exemption, but okay, I get it then. I get it. That makes sense.
Yeah. So a couple of the other reasons that you can be shorter than 2 years is if you're moving for health related purposes, and I'm
Okay.
not 100% sure what that is. Like it's like if you need to get treatment someplace, like when it's somebody in your household, doesn't need to be you, it could be your spouse or your kids or somebody, and maybe they have to go for some kind of specialized treatment, and they need to be near, like, everybody goes to Minnesota or someplace like that for, the high-end medical stuff. So maybe they need to move for medical purposes, or perhaps the doctor just tells them, you need a different climate, that, being here in the desert is bad for X, Y, or Z, and you just need the doctor to tell you need to move. And then that would count. And then there's also, and also if you have to go to care for somebody, so say you have like a parent or somebody like that, and maybe they're back in the Midwest still, and for medical reasons they need somebody to care for them, that will count as well.
Okay. So caring for someone else, and during COVID, that's probably a big thing, right?
Right. No, good point. Good point. And
Okay.
then there's also kind of this little umbrella thing called unforeseen circumstances. So this is basically something that you couldn't have known when you originally bought the house. And it's going to be things like you got divorced or legally separated, somebody died, you gave birth. I like this one. You gave birth to more than one child in a pregnancy. So it has to be a single kid isn't a surprise, I guess. Twins or more is a surprise. But
what if you end up moving next to a house where your neighbor has like they end up planting a bunch of weird plants that you're allergic to, and this is after the fact, right? Can you use that as an exemption?
Yeah, I mean, if the doctor can come along, if you get something with a doctor that says you're allergic to something in that neighborhood, maybe it's a chemical plant or something,
Yeah.
A lot of people in Louisiana, I shouldn't say that. But,
No, I'm just trying to think through this. Like it just seems like that's pretty loose.
here's one too. It says you become eligible for unemployment compensation.
Oh.
So it's really
that's an exemption. So
yeah.
so anyone who potentially lost their job or was let go or on a sabbatical or something last year, they were able to qualify for this.
Right. And there's a really big catch-all too. It just says called other facts and circumstances. So where the IRS is, so basically we have to just think of the concept of what they're trying to do. I mean, I love to make fun of the IRS and say bad things about them and all that, but they are humans and they're trying to be human most of the time. And so what we just think of the overall concept. The whole concept of this law was to say, we want you to be able to sell your personal residence and move to a bigger or another place and not have to be encumbered by this tax. And so how do we make sure that people aren't going to abuse this? Well, we'll make them live there for 2 years. If you're going to, they don't want people like doing flips, like come into the house to fix and flip it and move out in a month and try to avoid the game. So they figured 2 years, that's a good cutoff. And then they said, all right, yeah, there's some reasons people can't do it. So they're really looking for, was there a legitimate reason you had to leave and that you weren't trying to scam the system here. So the more if you can show those things, and I know it's weird to be touchy-feely with the IRS, but there is an element to that. And so if you're going to hit one of those circumstances, really talk to someone tax-wise, a tax professional, and they can work your way through it. So there's generally always a way, unless you're really trying to scam something.
No, that makes sense. So getting back to a question that I had for you a little while ago. Let's say somebody moves into a property and they end up, or let's say they don't move in, they buy it and they're going to rehab it before they move into the property. Okay, so I buy a house tomorrow. It's going to take 8 months for the house to be done, and let's say after 6 months I decide to move in because I can, right? And it's done enough. I might not have had the certificate of occupancy yet, but I need to move in for some unforeseen reason and I got to be there. When does the clock start in the IRS's eyes for when I moved in, or like when does the 2 years start?
My opinion would say that it's when you move in, not necessarily when you get the certificate of occupancy. But remember, so there's two elements we're looking at. We're looking at both 2 years of ownership. Okay. So that 2 years of ownership clock starts the day you closed on the property.
Yeah.
Even if it was uninhabitable.
Okay.
So that clock starts then. And then you have to your physical presence there, you actually living there would start the day you move in. I don't think that having that certificate of occupancy is a factor in this.
Okay.
The IRS might challenge it, but you need some way of if the IRS challenges, you need some way of documenting that you did move in at that point. So maybe you have something from a mover or electric bills or school stuff or whatever to show when you moved in, and the clock would start for occupancy as the day you moved in.
That makes sense. Okay, that's super helpful. I know that'll answer some things for some people with just that piece right there, because it's happening, and especially in this market, like, gosh, build outs right now and finding contractors to do like it's nuts. So yeah, we'll see.
To get drywall must be super expensive right now. They're remodeling a office space right next door to me in my building, and I saw them actually carrying out intact used drywall, and they're loading it onto that. So somehow they unscrewed this drywall. It must be, I don't know, it must be super expensive now that they're going to that effort.
That's amazing. That's pretty interesting. All right, next question. And this one, that time we had breakfast and you were talking about this, okay, the cost segregation study, and what is that? Why should real estate investors be paying attention to that? What's the benefit? And of course, like, it almost seems like it came up out of nowhere. Like I didn't even know that was a thing up until, a couple years ago. I was like, oh my gosh, that's interesting. So what is that?
So a cost segregation study, let's go back and say this all has to do with depreciation.
Okay.
And depreciation is really the magic behind real estate from the tax side point, right? So depreciation, it's a non-cash expense, right? It's based on the purchase price of the house. And so let's just talk about it. I call it a paper loss. It could help generate a paper loss. Okay. And so let's say you have a rental property that cash flows positive every year, $5,000. Let's make up a number. So every year you put $5,000 into your bank account.
Okay.
Let's say you have depreciation on that property of $7,000 a year.
Okay.
So I mean,
now you're saying that a house is going to depreciate like a car.
right. Well, I'll explain what I mean by depreciation in a second. Let me do the concept here. So let's say you have a deduction for something called depreciation of $7,000 a year. That means for tax purposes, you have a $2,000 loss. Even though you put $5,000 in the bank account.
Okay. So you made $5,000 on it, but the government is saying that you lost 7. So technically you lost 2.
Right.
Okay.
Right. Now there's some questions about whether or not you can deduct all of that, and that's for a different conversation we can have as to being a real estate professional and some other things about being able to deduct it. But that's the concept of creating these paper losses with real estate. Is it's one thing to deduct these expenses. Hey, I had to repair their furnace or whatever. But that's cash out of your pocket. Let's look for these non-cash expenses that they give us a magic. So the way residential real estate works is residential real estate is depreciated over 27.5 years.
Okay.
And residential is a different definition than the bankers use. Residential is basically anywhere people live.
Okay. So residential could be an apartment complex then.
It could be a 100-unit apartment complex is still residential.
Okay.
So 27.5 years. If it's commercial, it's 39 years.
Okay.
So 27.5 years. But that's really for the building itself, the real property. We talk real estate, so there's real property and personal property. Real property is 27.5 years. And if we don't do anything at all, we just take the 27.5 years. Now we have to break out the land. So if it's not a condo, we have to break out a little something for land, because even the government's not crazy enough to let us depreciate land. But the remainder, you basically take your purchase price, divide it by 27.5, and that's how much you get to depreciate every 12-month period.
But wait, you also mentioned that the land is not included. So
right.
If I bought a piece of property for $100,000, and now I take that 100,000 and divide that by 27.5, and that gets me to what, 3 and change or something. So that 3 and change is basically what I can write off or depreciate off of that property every year. Where's the land come into it?
So the land, so before we get to that $100,000 number, we need to subtract out whatever the value of the land is. Sometimes you have that number. Sometimes we'll often just use the rule of thumb that says if it's a single family resident, we'll take 20% of the purchase price and say that was for the land.
Okay.
So, in your case, we said if you bought it for 100, then 20,000 is land, 80,000 is what we divide by 27.5, and that's how much we depreciate every year.
Okay, so as an investor can basically take this information and say, all right, we're just going to use 20% as the land value, and that's fair enough.
That's kind of our firm's rule of thumb to say if it's a multifamily, we'll usually say 15% is land.
Okay.
So that's the number we get, and it's just another expense for that property that comes right off of the income, and it could either lower the profit or throw you into a loss.
Okay.
But we can speed up that depreciation, because really when you buy that property, you're really buying more than just real property. You're buying some personal property in there as well. Okay. Personal property in a rental can be depreciated over just 5 years. So personal property is defined as anything that you can remove without causing damage. So it's going to be things like kitchen appliances, countertops, cabinets, ceiling fans, window treatments, certain kinds of flooring and shelving and specialty lighting, all these kinds of things. Even though if you watch one of those rehab shows on TV and they remove them with a sledgehammer, they don't technically have to be removed with a sledgehammer. They can be removed without causing damage. And so the IRS says those are considered personal property and we can appreciate them over 5 years.
Okay.
There's also a second category that we can speed up depreciation in, which is called land improvements. I already said we can't depreciate land, But
Right.
there's things that we've done to the land that we can depreciate. Land improvements, we depreciate over 15 years. It's not as good as 5, but it's still better than 27 and a half. And that's going to be things like landscaping, irrigation, walls, fences, driveways, sidewalks, all these things, swimming pools, everything on the outside. So
So like
here in Arizona,
all the hardscape that you're going to do
yeah,
to a yard.
and the landscaping too, and the trees and the grass, and so yeah, in Arizona we actually get to depreciate gravel. So
Okay. Wow, that's cool. It's okay.
so
Oh, go
so
ahead.
oh sorry. So that's where, so how do you know when you purchase that property, how do you know how much of it is for the 5-year property, how much is it for 15-year property, and how much is it for the rest, the 27 and a half? How do we categorize that? And that's where we get something called a cost segregation study. And that's where we have a company come in, and they're appraisers basically, and they appraise each individual component based on your purchase price and say, all right, this is how we decided we're going to allocate that based on whatever criteria they're going to use to
Okay.
come up with those numbers. This has been around, these cost segregation studies have been around for at least 30, 40 years. They've been around for
Okay.
a long time. We didn't usually see it in the single family rental world,
Okay.
unless it was a very high end property, because I mean, if you take $100,000 property, right, and we start breaking it down, it's going to cost more to do the cost study than it's worth, and it's a
Right.
lot of effort. What changed was in the 2017 2018 tax law that was the most that passed.
Okay.
They created something called bonus depreciation. And this is not just real estate specific, but it did apply to real estate, or does apply to real estate.
Okay.
And what that law said, what bonus depreciation is, it said, okay, anything that you guys bought that has a life of 15 years or less for depreciation purposes. So
Okay.
the two things we just talked about, the
Yeah.
outside and the inside,
Inside is right.
you're allowed to now depreciate that 100% in the year that you purchase it.
Okay.
So we get a giant upfront deduction that throws us into a loss. And that's where the cost seg studies all of a sudden became worth doing, even on smaller single family homes.
Okay.
But they're especially valuable in multifamily homes, because if you think about it, the most value we get for depreciation comes out of the kitchen.
Mhm.
And so the more kitchens we get, the more depreciation we get.
There you go. So you're writing off every single appliance every single year if you just keep redoing that cost segregation study.
Well, the cost segregation study starts out with, this is what, the day you purchased it, this is what you bought. And so let's say it's $30,000 out of the 100. Wow, that's pretty big. But actually, we'll find, depending upon the quality of the finishes and whatever you're doing, and some other factors, in a single family, it's not outrageous to say that 25% could be in between 15 and 5-year property. So $100,000, you get, that's a 25,000. You might get a $25,000 write-off year one.
25,000, and it's not just appliances then. You're talking about like everything.
Right. Well, again, yeah, the cabinetry and all of that stuff.
Interesting.
So
Okay.
so that's where that's why I'm talking about the magic. That's where this really comes in. We have some guys that, they will, I mean, on a bigger scale, they'll take down, apartment complexes and do a cost segregation study and turn out to be, several $100,000 year one deduction that they end up paying zero tax. I know people get mad about that, but they're following the rules, right? They're paying
Right.
zero tax, even though they have a multi-million-dollar net worth because of all these properties that they own. So they'll buy a large property every year to wipe out all their other income.
Wow. Yeah, that makes sense. That answers that question. I heard something here in the last year, which was interesting. That let me know what you think of this. So there's all these people talking about how it's our patriotic duty to be paying taxes, right? And there was someone who came up with just the opposite, and he said that the gosh, I can't reference what his name was. He is an accountant that works in basically wrote a book. And unfortunately, I'm not as gifted as you at understanding the accounting stuff. So I did last halfway through the book, and then I had to put it down. But basically what he said was that it's your patriotic duty is to not pay taxes, because that's doing the things that the government wants you to be doing.
Right.
That's why they give you the breaks. So instead of government subsidized housing or anything like that, they just say, hey, go out and make these investment properties and we'll give you a break on it. Right.
I think I know who you're talking about, and I'm not going to promote him, but he used to be my boss, and he actually stole that saying from me. But that's all right. I don't hold a grudge.
Nice.
Because he is here in Arizona.
Yes.
So, but yeah, that's what I said. Is basically think of what you're doing, right? When you're a landlord, you're renting out property, right? You're providing a place for people to live.
Right.
And if the private sector didn't do it, the government would have to do it. We know what a horrible job they do when they try to do, rental properties. So I don't know that it's a patriotic duty. I just think that, the government, there's most tax breaks work this way. And I really wish it didn't, right? It kind of sucks that it does work this way, but the government uses the tax code to bribe us to do certain things that they think are in the public benefit. And one of those things that they see is, we need housing. And so here's one of the ways we're going to bribe you into doing it.
Mm-hmm.
Now, not all the politicians understand that all the time. And sometimes we'll get changes and then they start seeing the negative side effects that occur. Now, I do want to throw in here, and it's just one wrinkle, and I won't go into detail with it, I promise, but don't just run with what I just told you on the depreciation side. There are hoops you need to jump through, because remember I said your ability to be able to deduct that loss.
Active versus passive.
Because this is considered a passive loss. So there's some hoops we have to jump through to be able to deduct it. And sometimes for some people, it might not be deductible. It will be deductible at some point in time. It's just a matter of when you can deduct it. A lot of people can deduct it right now. Other people have to wait till they end up selling the property or whatever to be able to deduct these losses. So definitely talk to your tax person about that before you run in and just do it. But
yeah, we definitely run into that a lot, because some of our investors are active investors and others are not qualified as active investors. So that's why I appreciate you helping us with this video, because it's coming from the source. It's coming from the guy who knows it all, right?
And it's still a really good thing, right? Some people go, oh man, I don't qualify to be able to deduct the real estate losses. And it's like, well, don't look at it as a negative thing. First of all, you will be able to deduct it at some point in the future.
At some point,
but look at it this way. Let's go back to my example where you had $5,000 of positive income and $7,000 depreciation. So you have that $2,000 loss. Okay, so you can't deduct the $2,000 loss today.
Right.
But guess what? People look on the dark side. Look on the light side, right? Look, they forget the fact that they just put $5,000 in the bank tax free.
Yeah. Nice. I like that. That was like your mic drop moment right there. You're just like, boom. That's awesome. Okay, I dig it. That's super, super helpful. Understanding the cost segregation stuff. Like, I thought I knew it a little bit, but now you just helped me in understanding it even better. So I totally appreciate that. And I know that other people are going to feel the same with that part of the video. Yeah, both parts so far. Okay, so then getting back, we probably should have put this one first, but it's, what are the ways that real estate investment properties benefit someone from a tax perspective, and why is it important? I think that's one of the topics that we never talk about, like in public. I think talking about real estate investing isn't sexy unless it's a cabin, in the woods, or a condo on the beach. Like, people don't want to talk about real estate investments because it's, I don't know, for some reason it's taboo, right? And beyond that, take it a step further, and you really don't want to talk about the tax benefits of it. Like, that's not like dinner party talk, right? So what are the benefits?
You need to be in the right circles. Then it's dinner party talk all the time, and that's how you find out about some of the good deals. But anyway, uh, uh, so I mean, we were just kind of alluding to mostly the biggest thing that real estate does for us tax wise is it allows us to create those paper losses.
Okay.
We don't want real losses, right? No, even though we can deduct real losses, you know, and I have this conversation with people all the time, even when we're talking about expenses and other things, like we're not at the 100% tax bracket. It might feel like it, but we're not at the 100% tax bracket. So you don't want to lose money just because it's deductible, because the loss is 100% and the tax savings might be 20%. So, you know, you don't want to lose money. But paper losses, as we said, is not real cash, right? So paper losses are what we want. And real estate is one of very few things out there that allow us to have these paper losses. And again, whether we get to do the paper loss today because we are a real estate professional actively involved in this, or our income's under a certain threshold, or that depreciation or that write-off might be, you know, that deduction might be a couple years down the road, it's all good, right? We're saving this money.
Yeah, no, I think that's super helpful. So quick question for you. Cost segregation studies, what does somebody expect to pay for something like that? Like if they've got a portfolio of you know, residential properties, can they do one study for all of them, or how does that work?
So generally you're going to do the cost segregation study when you buy the property, or as
Okay.
soon as you bought it, as soon as you can to it. You can technically go back even you can go back like 5 years or so and make these changes. The further back you go, the more the return diminishes, but you can certainly go back at least a couple of years to properties you bought from 2 years ago, and it might still be worth it to do the cost segregation study. It's really going to depend upon the type and size of the property and
Okay.
where it is to tell you the cost. I mean, the cost can range anywhere from like $500 for a little 3-2 rental property somewhere, all the way up to you know, you know, 10, 20, $30,000 for a big apartment complex. But there's companies out there. I don't want to like mention anyone particular
Yeah,
here,
sure.
but there's a lot of the companies out there, and if you want to even contact us, we can connect you. But they will give you. There's one company in particular we work with that I really like. You give them the address, and I
Okay.
don't know how they do this, but you give them the address, and they will give you their estimate of what they think they can get in depreciation after they do the study. They have some formula they do, and they're pretty accurate with that guesstimate of what they think the depreciation will be.
Okay.
And they'll also tell you what the cost for them to do it will be, and all that they do free. And so you're not
Oh, that's
obligated. So you can look at that and go, okay, and then you can give us or your accountant that number they're going to come out with, and you can quickly figure out that it's going to be worth it to pay
whether
them.
it's not worth it. That's a great idea. Okay.
And here's the thing. So we kind of use and abuse them a little bit, but we've had clients where, you know, the target, we have a certain target for tax purposes. We need to get a certain amount of depreciation for them, and maybe they can only afford to buy one more property, and they're looking at 3. So we've actually gone to these guys and given them all 3 addresses, and they came back. So we figured out which one had the most depreciation potential, and that's the one we had them buy.
That's a great idea. How long does it take what's their turnaround? Like how long does it take them to get that back to you? Pretty
Like a
quick?
week, like a week, yeah.
Okay. I like that. That's a great strategy.
So off air, I'll hook you up with that guy, and he's a really nice guy, and he's local, and you can. So if you're looking at people that are on the fence about that, they're really, really good about this.
I love it. And that was wisdom with Warren on Wednesday, if it was. See, that would have been it right there, man. Boom. That was it. I love it. Thanks, man. Thanks for sharing all this stuff. Hey, so how can people get in touch with you? Like, what's the best way to connect with you?
Our website, my company is Taryle Accounting. CPS. I'll give you this. I know it goes to a lot of people. This is really mostly for our clients, but
Okay.
if they're friends of yours, they're friends of mine. And so we do, and we're recording this on a Thursday. So it's funny because every Thursday we do a conference call for people who have quick questions. I mean, we don't have a curriculum we teach or anything like that. We found that, you know, we don't mind answering quick questions, but we started getting so many questions we couldn't get any work done. So we said, what if we condense it all to one day a week on Thursday afternoons, and people can call and just ask questions. It's not private, so other people are going to be there, but you don't have to say who you are.
Okay.
And some of the accountants here kind of take turns each week doing it. And so you can call in and ask your questions. If you're really, really bored on a Thursday afternoon and you want to hear accountants talk about taxes, you can call in and just listen, because a lot of people are going to be doing the same stuff as you anyway. So it might be questions you didn't even know you had. So
Yeah.
So here's the phone number.
Okay.
It's area code 712
Okay.
775 7100, and the access code is 349590#. And we do this every Thursday at 3 o'clock Pacific time. So we don't use Arizona time because it confuses everybody, because we don't do daylight savings. So we just quote everybody on Pacific time.
Okay. That's awesome. I love that. I will put that out there to the universe. And for those of the people that watch this whole video, they're getting that huge nugget at the end. And yeah, I mean, that's huge that you guys do that, man. That's amazing. I know some people right away that I could get over to that and get that information, and they would find that extremely helpful. So thank you.
I'm sure.
Yeah.
So otherwise, yeah, we're Taryle Accounting. You can like us at Taryle Accounting on Facebook. Our website is tacpas.com, and that'll have all of our contact information as well.
Perfect. I'll also put it in this video, so people that are watching it can see the links down below too, so they'll know how to reach it.
Awesome. You're a video magician.
Yeah. Wait till you see it first, man. Then you can tell me. Cool. Warren, thanks so much for your time, man. I appreciate you.
That was a lot of fun.
Yeah, for sure. I think this is super helpful, more helpful than you know. I think people are going to watch this, and I'll make sure that people know like what segments they can find what information, because I think that'll be super helpful. Because I mean, I've learned a lot from this right here, and shoot, I'm in the business, and this was super helpful for me. So thank you.
All right. Well, thanks, Ed. We'll talk soon.
Sounds good, man. Good to see you.
Bye.